Is this as tough as you've seen it since you've been following the markets?
Yeah, if you go to a bar or restaurant in CBD Auckland on a Thursday night, you think, oh God, what recession, right?
Yeah.
But you get the real numbers, 6% unemployment in Auckland.
We've had such a good run with those US stocks. It just seems like it's all going a little bit too good to be true in terms of markets because they just keep going up.
We've had the trade war, we've had tariffs, rates going from like next to nothing to the highest they've been in the US in over 100 years. We've had backtracking, we've had threats, we've had countries targeted, we've had industries targeted, but the markets have just all taken in their stride.
Today we have a very familiar voice in the studio, Greg Smith, who has joined Generate as an investment specialist. It is good to see you, mate. I see that you've been out there and very busy in the 4 weeks that you've been involved with Generate, so we get to steal some of your time today.
Thanks. Hey, great to be here as well. Thanks for having me along. And yeah, you're spot on. Generate's an amazing place and really enjoying the experience and the journey to come.
And you've been involved in this space for probably 25 years. Now, what keeps you in the financial services industry and talking about markets and getting up at 5 a.m. and going on the radio and all the different things that you're doing day in, day out?
Yeah, it's funny because I said 25 years on the bio, but when I think about it now, I'm showing my age a little bit in the grey hairs that I first invested in the stock market in 1987.
Oh.
And for those who are a bit older probably know, that actually wasn't a great year to get started. And in fact, I think my first company I might have bought was Briley. But I actually have always loved markets. I've always been fascinated by stocks and shares and the growth prospects that can come with that. But yeah, really that journey has continued. I just really enjoy, helping people with their investments, hopefully helping to get across some good advice. It's great to have this role at Generate where I can sort of be the conduit and communicate what our investment team are thinking. And that's something that I really enjoy. I'm one of those geeks. I'll get up at 6 a.m. or 5 a.m. and watch Jerome Powell and dissect what he's saying, and Bloomberg will be in the background or CNBC, and between the kids sort of trying to change to something a bit more digestible. But I do love markets and do love sort of everything that sort of goes with it and the impact that it has on people's sort of financial wealth, and it can be a positive one.
Keen then, seeing as we've got you here and you've got that history of your own first share purchase, because mine was 2007. Oh. So we probably don't have a good entry point. How did you buy a share in 1987? Like, what was the process? Because we hear from a lot of people that, didn't have exposure to this, didn't know how, it was very hard, people just didn't do that, but people obviously were. So how did one go about buying a stock back in 1987? Yeah,
so you had to call up your broker. There was no internet around there, right? So it was phones. There was no mobile phones. So it was a very different process. It was paper based in terms of the confirmation. Things took a little longer to sort of happen. But look, it did teach me some valuable lessons. Actually, sort of thinking about it now. And one of the first ones is sort of not doing your own research or not relying on credible research. And I remember sort of a friend at school, last year at school, so I'm sort of giving it away here, but he said, bought these amazing companies, they've done so well for me. And, one of them was Briley's, and there was a couple of other names. And just relying on, not having any context about whether the share was overvalued, whether it was just literally because someone else had bought it and had a good experience. So it was probably a little bit of a tough lesson, but it was a very valuable lesson sort of later on. And that sort of served me well, personally, going on many years. Obviously you talk about 2007, the financial crisis, and I can remember, we were involved in a business in the UK and just had this view, there was something going on with the financial sector and it wasn't good, and obviously that was where it all started. But before that, we had the dot-com boom, of course, and it was a similar situation because in the late 90s, literally people were buying companies just because they had online in the name or they'd heard it for a friend, and it was just literally, it was FOMO. That was my probably first experience of FOMO. And sort of having been a little bit conditioned by my first experience, I thought this is, if it sounds too good to be true, it probably will be. And but obviously that process, that bull market then went on for quite a while. And even the most staunch people that were like, this is crazy, actually did get sucked into it. So and obviously history repeated again in 2007. So these experiences, I think sometimes leave a bit of scar tissue, but hopefully provide some valuable lessons and learnings.
Well, then take you to 2021. Did you because that would have been your sort of third or fourth time going through some of these cycles of, suddenly everyone's telling you what stock you should be buying. Did you see the same things in that 2020, 2021 period, especially like the New Zealand market?
Yeah, for sure. I think and obviously COVID was not something anyone had experienced before, and it was all pretty scary. And we had a very vicious market reaction, and some were sort of labelling it as a new bear market. It wasn't. It was actually very, very short. So markets often overreact to news in the short term. Both positively, but also a lot of the times negatively. So I think through that year it was like, hey, this probably is going to work out okay. None of us are sort of health experts, but you sort of had this idea we're going to get through this. There's going to be a vaccine. It's not the end of the world type thing, and sort of so it proved. But that was obviously a very, very interesting time as well.
Yeah, I remember seeing a news article about a share club, and I remember thinking, I've learnt about this, that by the time a share club story ends up in the mainstream news, especially in New Zealand, that's probably not a good sign about where the markets are going, and thinking, but maybe people are just learning about shares now, ignore that.
Oh, that's right. And before going back to before the internet was sort of in abundance, you'd have share market tips in the newspaper. Oh, yeah. And I used to say, to people, why have you bought this? Or I saw it in a column. And said, well, you saw it, but so did like 200,000 other people. Do you think that maybe is why it might be going up, at least for a while? And that actually brings a point, maybe we'll come to a little bit later, about passive investing, because there's actually a bit of crossover there.
Yeah. I remember some of my early stocks myself, Feltex Carpets, Lombard Finance. Do not Google these, anybody. I got into A2 Milk nice and early. I think my first stock was Auckland Airport, and my rationale was, I would have been 17 or 16 at the time, we'll always need an airport. So I thought that must be pretty safe. So I put my first safe investment in, and then I think I was like, well, why hasn't it gone up double? Like, I want more. This is slow. And then I started looking for things that might pop, but they certainly popped the wrong way, and that was to the floor. But you do learn a lot, I think, through those early years. And I think you either, you love it, or you have to accept that investing actually should be really boring, and then you do get into funds and different things like that, so that you're not, reading about a company that you've invested in and then going, maybe I should take it out, maybe I should put it in, because it's a massive roller coaster, right?
That's right. And good point about the airports. I mean, obviously, of course we need airports, we need lots of things, but when you're investing in a stock, in a company, it comes back to valuation. A lot of the time, okay, it's a great concept, but this Auckland Airport's been around for a long time. It's not new. I mean, is it overpriced? Is it underpriced? Is it about right? And that's ultimately the question. And then sometimes, are there more buyers and sellers? Enters into it, of course, as well.
Well, let's get into some of what we're seeing out there, because it's a very unique time again here in 2025. You've got all-time highs over in America. You've got GDP print in New Zealand of negative 0.9, which I think surprised everyone. And you've got the tech space going crazy. You've got AI. We've got more people having access to share investing in New Zealand and learning about it. We've got term deposits. There is just so much to talk about. What's your kind of overall take on what you're seeing out there?
Yeah, well, it's uncertainty is a word that often gets mentioned a lot. But then again, as you say, a lot of markets have had a really strong year, despite, we've had geopolitical events, we've had the trade war, we've had obviously a certain person in the White House, which has caused, a lot of reaction. And that's, before you get into the sort of normal everyday stuff that you expect in economies and markets. So, but markets have continued to push high. I think it's been fascinating that how that's played out. But there's still a lot of uncertainty around. Obviously, there's been cost of living pressures. Inflation has sort of become. I mean, that's become a sort of a very normalised word now. Maybe 10 years ago, even inflation wasn't probably that common a term to use, but now gets used every day because it's had such an impact on everyday people's lives. Also been very relevant to the market in terms of the economy as well, and our employment is another one. So it's all become very relevant. And interest rates, obviously, that's been a key one.
Well, let's look at New Zealand to start with. And did the negative 0.9%, did that shock you when you saw that, or we weren't too surprised?
I think the interesting thing is it didn't shock. It didn't shock at all, actually. And I think sort of going on the radio pretty regularly and talking about it, it's easy to say, oh no, predicted it. I mean, it certainly didn't predict it, but wasn't shocked.
Yeah.
Our investment managers get around and see companies that are listed on the market, but also get around and see plenty of others that are not, and get a good feel for how the economy's doing, how the country's doing. I think as individuals, you sort of do that as well. You get a bit of a false sense of things sometimes. If you go to a bar or restaurant in CBD Auckland on a Thursday night, you think, oh God, what recession, right?
Yeah.
But then you think you get the real numbers: 6% unemployment in Auckland. It's been a tough time for our economy, and there's a few reasons for this, and you could probably spend a few hours debating this. But look, the reality is our central bank was one of the first in the world to raise interest rates. They went pretty hard. I think they were second only to Norway. So that New Zealanders love property, and naturally going with that, there's a lot of borrowing for that property. So when we had, obviously we had the party times when everyone was going out and buying plasma TVs and refrigerators and
jet skis,
whatever, right? And then I can remember at that time, actually in 2021, and remember the peak of the housing market was in 2021. You'd say to someone, why have you bought the house or a second house? Oh, it's a good time to buy a house. Why is it a good time? Oh, because interest rates are low.
Yeah.
Okay. And I can remember, I'm not going to give any names or anything like that, but I remember meeting with an economist once and around about December 2021. I said, what do you think is going to happen to the property market next year? And he was like, it's going to flatline. It's going to flatline. I said, okay. What do you think will happen when interest rates start going up? Because we're starting to get inflation, and you've had all this stimulus that's got to be withdrawn. Because again, it's going back to seeing what's happened in previous cycles. People just cut back on lattes or whatever. I'm thinking that's a lot of lattes. And talking about a real world experience, I saw one of the country's top auctioneers that same week, and he said to me, this is going to be a bloodbath.
Really? Wow.
He said clearance rates are 40%. No one's talking about it because we're going into Christmas, but this is going to be an issue for 2022. And he was absolutely spot on. So I think it's fine and it's really tough to be an economist or anyone trying to predict what's going to happen financially, but talk to people in the real world. And my son is trying to get an apprenticeship as an electrician at the moment. He hasn't been able to for 6 months. It is tough. Anyone in the industry will tell you it is the toughest it has been, not just in recent years, ever, in the construction industry. So, make no mistake, and certainly not blaming it all on the Reserve Bank or anything like that. But that was a compounding factor. Obviously, we had a cost of living crisis. Our economy is perhaps not as diverse as some others. We don't have the minerals of Australia. We don't have the tech industry of America. Fortunately, we do have some parts of our economy which are doing well, right? Dairy, Fonterra's come out for a really good full year result. Horticulture, kiwi fruit's doing well. Tourism, I think we're going to talk about that, is doing quite well. But we're under the pump in a lot of other areas of the economy.
Speaking of your son, maybe there's an electrician listening that might be looking for an apprentice. So,
I'll give him my give him the details afterwards.
Perfectly. Search up Greg from Generate and you'll be able to find him. Have I made this gag up, or is this, you've been in the game longer than I, but I came up with this week, maybe we need to respell economist from economist, M-I-S-T, to econo, M-I-S-S-E-D?
Yes, it could.
That's good. Is that me, or have I come up with that?
That works.
Yeah, nice. Why do you think, just quickly on that, why do you think these economists get it so wrong? Because I'm a bit the same. I get to talk to SME business owners all the time and get to see on the ground how they're thinking, what they're doing, what they're planning for. And I think that's a better barometer of the economy than someone in looking at charts telling you, oh, here's some charts and here's what we think internally. And sure, they've got transaction data and whatnot. Or, hey, here's Professor from AUT. Give me the people on the ground. How come they get it wrong so often?
Yeah, it's probably just, maybe it's that, I think most economists that I've met are brilliant people, and, have all the mechanical skills.
What we say here.
I'm going to be very, very careful, but no, they are brilliant. It's a really tough gig. I mean, I would no way I could do that. But maybe it's just that real world element. I'm not too sure. I was actually seeing a little bit that talked about with the RBNZ recently as well, in terms of getting out of Wellington and sort of seeing what's going on. And I think everyone, myself included, you get stuck in your own little world, and so I think it's just about broadening it. But maybe that's part of it. But it is tough. I mean, and we're not just talking New Zealand. We're talking. I mean, there's been a global gag around about economists have predicted 15 out of the last 5 recessions. It's so. That's sort of not new material in that respect, but it is tough.
Getting in the KiwiSaver fund that suits you and your situation is key to making sure you're maximising your investment. Generate are an award-winning KiwiSaver provider with a track record of long-term performance, and they can help you do exactly this. Their advisors can meet with you to talk about all your options when it comes to KiwiSaver to help you decide what's best for you. Too many people never get KiwiSaver advice, but not you. Go to generatekiwisaver.co.nz/change to book a no obligation chat with a Generate advisor. A copy of the product disclosure statement is available at generatekiwisaver.co.nz. The issuer of the scheme is Generate Investment Management Limited, and of course, past performance does not guarantee future returns. I did notice that the new Reserve Bank Governor, I saw her saying that she's going to get around New Zealand, which I took for meaning to get on the ground and hear from people. Maybe she just means go and have a big tour of the place, because I believe she might have been here once, July, maybe for an interview. I don't know.
Yeah, that's right. Yeah.
But new governor, can we expect much change or difference, do you think?
Yeah, it'd be interesting. So first female, second foreign governor, actually. We actually had one back in the 30s who was a Brit. And it's actually relatively uncommon to, I was trying to find the other sort of Reserve Bank governors globally that have been foreigners, and there's one well-known, Mark Carney, who was governor of the Bank of England. He was actually Canadian, but I don't think there's too many, if any others. So it's quite unique. So she'll have to get up to speed. So why not get around the country? But I think we'll be really well. Amazing pedigree in terms of coming from the Swedish central bank and senior academic positions, institutions, including the World Bank and one of Sweden's biggest commercial banks as well. So I think that certainly won't be an issue. The other thing is Sweden has had a similar experience to us. Like, their housing market got really whacked, and their economy has been pretty fragile as well coming out of it. So there's some commonality there with what New Zealand is expecting. So I think it'll be an element of freshness. I suppose one point I would make, she doesn't actually take over till December the 1st. So we've got 2 official cash rate decisions before then. And we're just talking about that GDP horror show before. There's a really good chance now that we're going to see the cash rate cut by 0.5% when it comes to that next meeting in early October. We might see, at that point, another 0.25 point cut at the next meeting. So there's a possibility. We're at 3% currently on the OCR, and we could be down to 2.25% potentially. Not guaranteeing we will. Not being so a lot of the not heavy lifting is actually the inverse of that. But on reducing rates will have been done by the time potentially that she arrives. There's been some comments that about, they always love to talk about whether someone's a hawkish tendencies or dovish tendencies. Probably will sort of leave that out of it. But probably a lot of the near-term monetary policy decisions may well be done by that point. So, but maybe it might the ports of call will be about restoring. Use this word carefully, but the Reserve Bank's been through a lot this year with Adrian Orr and questions over policy generally, and it hasn't been great. So just restoring some stability, I'm sure, will be her mandate, and then obviously looking at bank capital requirements, that'll be an important thing as well. Yeah,
I often say when I get around the place, can you name the last Reserve Bank governor before Adrian Orr? And most people can't in any room, right? And I think it's a good indication of how serious we've become about learning about inflation and how big his profile was, But the thing that I always find interesting about, GDP's down, so we need to cut interest rates, but that inflation rate's still pretty sticky, 2.7 at the moment. But then as the general basket of goods, but then you go, well, food's at about 5%. Greg Foran said, right, I'm leaving soon, but here you go, here's 5% price rises. You know, flights are going to be more expensive. Insurance is up about 900,000% or something. Rates as well. So those, just some of those things, and then coffee might be going up. The key things that I think people like to spend money on, especially as we go into a summer period, are tracking higher than the general basket of goods. So I'm a little bit scared that we're like, cut the interest rates to help the economy, great, and unemployment, but we end up with sticky sort of high 2.8, 2.7, 2.9, and you can lose a lot of value in a currency even at 2.5% to 3% loss of purchasing power every year, right? Compounded.
That's right. Look, there are a lot of moving parts, and the inflation is, and actually the RBNZ mandate was actually changed from effectively a dual one like the Fed has to a single one of price stability. So in theory, that's all they're concerned with. They're not, but in theory, it's what's inflation doing.
Yeah.
And obviously through that period where inflation was and still is under the microscope, there was a lot of things that, like you've mentioned as well, that might not have been impacted by the OCR going down, or certainly not impacted adversely. So rates is a good example. You change the OCR, it's something else driving that. Rents, in theory, if you drop the OCR, rent inflation should improve, over the longer term anyway.
Yeah.
So there, a couple of big drivers there. Yes, and then I suppose the issue is as well that if you're reducing the rate and the currency's falling, then that makes imported stuff more expensive. So that's all it's tricky to work out.
Yeah.
But then I suppose what they're trying to control as well is which we saw in the early days of COVID, rates were reduced to near zero. What do we all go out and do? We talked about before, spend.
Yeah.
And then after any party, there's normally a hangover, and that we had a very long hangover.
Yeah.
For the economy.
Is this as tough as you've seen it? Since you've been following the markets.
It is. Yeah, it is on a number of accounts. Just the I think there was the emotional relief as a human about getting out of COVID, but then God, you think of all the sort of consequences since, and it's been very tough. So if we want to talk some positives, we can maybe do that. So we've got obviously the OCR has been reduced. In this country we tend to have, I mentioned before about property and household borrowing and so on. So we tend to lock ourselves in, don't we? On average, and I'm not statistically backing this up, but I feel like it's around about a 2-year term that a lot of people go for, right, when they're fixing their mortgage. So we've got a bunch of people that have been locked into pretty high rates for a long time. So again, I see this figure bandied about a bit. I think it might change a little bit, but we've got around about a half of all mortgage holders going on due to refix the next 6 months. So if you're going from a rate with a 6 in it to sort of 4 point something, high fours, that's going to help you out. If you've got a $200,000 mortgage, a $500,000 mortgage, or a much larger mortgage. So I think that's going to help. The consumers, if they would generally, and you mentioned food inflation. That's something else as well. Obviously, that's quite a political issue as well. No sort of easy fix there. People want, you look at what you're paying for. I think a block of cheese has tripled in recent years in terms of price and so on. That's all pretty tricky. But there is a bit of respite coming, I think, through lower borrowing costs, which is going to help. The inflation rate is coming down generally, but as you say, some stuff is still pretty sticky. Rental inflation actually has been coming in terms of the growth there. Actually, it's been the lowest it's been for a few years, so that's pretty good news. And then if the consumer starts to function a bit better, then I suppose and tied with this as well, and this is back to the other sort of issue, where we've got this love of property and there's this wealth effect, right? If your property is going down in value, you don't feel as wealthy, whereas if it's going up, and that's for a long period we were used to just property prices going up and up and up. Not sure that's going to turn around any time soon, but people should be feeling a little bit better about things going into early 26 and beyond, and then that filters through to the rest of the economy, right? Manufacturing, the GDP number we talked about, manufacturing was a big weight on that. So unfortunately, when manufacturers sort of close, it's hard to bring that back, but we should do over time. So
Yeah, I'm confident that we'll have a good summer and people have a little bit more in the back pocket. I think people that have been refixing to a lower rate have been burnt by high levels of debt, so they've gone, I'm gonna clear my mortgage a bit faster. They've learnt about that, great. I do think we've got a mini wealth effect for the younger demographic that are going, my KiwiSaver's doing pretty well, because a lot of that's invested offshore. Mine personally has just gone past 150K. It was 100K, I think, 14 months ago.
Yeah, great.
Pretty unreal to, bolt on 50 grand in that short period.
Compared
to, yes, yeah, of course, yeah. And then like people investing and stuff, so there's a little bit of that wealth effect for those younger people. I wonder two things. One, what's the headwind going to be of this aging demographic? And two, where they did park their wealth. So let's talk term deposits, and I believe you might have some stats on term deposits, because I'm fascinated on where does all that money end up? Does it live back in term deposits, and they accept the lower rate, or do they start looking at investing again? What's your take on that? What do you think may happen?
Such an emotional driver, isn't it? And just the example I used before about rates being very, very low and people thinking it's a good time to buy a house. Obviously, when rates are high, people think, it's a good time to put some money in the bank. So you're getting 6.09%, I think was where the average sort of rate peaked at. And it's fascinating, household investment in term deposits went from in 2022 around about 100 billion to in July this year 160 billion. So, we've seen a massive push towards that, and that sort of sucked a bit of money out from elsewhere. And obviously having cash tied up in term deposits from the economy's perspective is actually not that productive. But now we're sort of going the other way, aren't we? So we're going from an average rate of sort of in the sixes to an average rate below that. I think it's around about sort of 3.8 something at the moment, something like that.
And you may lose 30% to tax, maybe, or even 17.5%. But let's say you're losing a third of that to tax, and so then you're left with like a 2-point-something% return.
Yeah, and then if you net it out for inflation, you're sort of pretty much you're even.
Yeah.
Maybe at best. So that's, I think, why we will see, and we are starting to see that reverse. And people that have had money tied up in term deposits are going, okay, that was good then, but now I'm not getting that, and I'm actually, I'm barely going to grow my asset base if I stick in the bank. What are the other investment options? Obviously, Kiwis love property. That's not looking so attractive. I'm not saying it's not going to pick up in the next few years. So but see more and more look to stock markets, look to invest. And you mentioned the offshore. Obviously, offshore markets have done very, very well. S&P 500 has been at record highs in the US. The many euro indices have been at record highs. The Australian stock market until recently was at record highs. They performed strongly. The New Zealand stock market as well. Actually, a point about that is the average dividend yield is around about 4%. So you're actually getting more in terms of this is on the whole market now, in terms just of a dividend return, and we've got companies returning a lot more than that in terms of dividends than you would getting a term deposit rate right now. And then also you've got those capital growth prospects potentially. The New Zealand market has lagged a bit. I mean, I think it's around about flat year to date, up about 8% since April.
And just the money goes running away from the New Zealand market when the volatility comes and those stocks start going backwards, because as much as they may like a 4% return as a dividend, they go, but I might lose some of my capital, therefore I will park it with the bank's term deposit product. Is that kind of loosely what happens in that down phase? But now we're starting to see some of them come back up?
Absolutely. And there's some great companies listed on our exchange. I mean, we've got a relatively small exchange compared to those globally. There's the NZ 50, they're the top sort of 50 companies, and then you sort of, get down a little bit further. But some great companies there. There's like anything, there's some companies are, reasonably valued. There's perhaps some that are not. It's like we were talking about before. You've just got to look at the valuations, look at what the prospects are. But we've got a lot of defensive companies here, I suppose. We don't have the tech names so much that the US does, but we do have some great companies and that are making, are doing very, very well offshore. I mean, Fish and Paykel Healthcare, our biggest company, is around about 15% of the index, and that's a global leader in its space.
I saw Freightways.
Their
CEO talking about, they were being asked about what they thought of the market, and they were saying, we finally feel like we're through the headwinds, it's not as tough, but we don't have a tailwind yet. And then the interviewer was asking, well, with that knowledge, are you more confident with your investing? And the CEO was basically like, we haven't really stopped investing throughout that. Our team are pretty good at managing these situations. We control what we can control. I thought, wow, what an attitude, like how good. And then you go and have a look at their stock price over the last 5 years, and it's basically like ridden up, and then they've been slammed, and now they're back, I think, at nearly all-time highs, and then you drag it out to 10 years, and really it is just up and to the right. I think they employ 5,000 people internationally, is that right?
Yeah, that's right. They've actually been really consistent, and another interesting business that's just done well from having being a bit diverse. So we talked about how tough it has been for the New Zealand economy. So if you're an inward-facing company with just the New Zealand economy, you probably found it a little bit tougher, or a lot tougher in some cases. You think of Fletcher Building, for instance, though they have Australian exposure as well, but that's probably a topic for another day. But Freightways has got an Australian business. It's also benefiting in New Zealand from a normalisation of pricing. So I believe their main competitor is NZ Post. So the government sort of said, no, you have to be commercial, so prices are starting to lift, so that's helping them out. So great companies like that have got a good story. Exporters, I mentioned Fisher and Paykel. You got A2 Milk,
Yes.
Doing very, very well in China. Again, they've had some headwinds there, but they're taking market share, and they've had a great year.
One thing I was going to ask you, because what I spotted with Argosy Property, I think it is, and then Kiwi Property Group, like if I go and have a look at their stock prices, I just noticed that all of a sudden in the last 6 months, like I don't quote me on the exact percentages, but let's say like a 20% sort of gain, but it's very clear on the graph, wow, the investment is returning to these stocks, and you think, but the commentary in the media and the data that we just got, GDP's ugly, and I always think, like, does the market know before the person that this is where we're going? And you look back and go, oh, like how did they start investing 6 months ago, really at the bottom, and now we're up 20%? Or what can we learn from that? Or am I trying to find something that's not actually there?
I think that you make a really great point. So there's a few points of this. So there's the property stocks, obviously, but I'm talking Argosy, Kiwi Property, which is Sylvia Park, and you've got Precinct, which is a big office name. So it's not so much residential property. We just talked about how that's sort of been sort of flatlining. Yeah, they're involved in industrial in some cases, which has been doing quite well. Commercial, office, A grade has been doing pretty well. We talked about inflation before. Rents have been strong, so that's helping them out. If they've had high quality assets or buildings, they've got very high occupancy rates in some cases. And some of them actually still I was looking at a couple of million, I won't name the names, but they're still trading at discounts to their net assets. So you're still in theory getting, they're effectively backing of their stock or asset backing of their stock at a bit of a discount. And the other thing is also, I think, related to what we were talking about earlier, that you, from an investment demand point of view in terms of the stock market, you're seeing a lot of investors more attracted now to the defensive aspect of these REITs, effectively real estate investment trusts, with term deposits coming down. So I think that's sort of fueling some demand in the retail sector as well.
Well, people are probably sick of me talking about New Zealand because they want to start talking about some US stocks, but I promise we will get to that. But lastly, the other headwind I was thinking about is like young Kiwi leaving New Zealand, and that's not great, right? Like it is, we're training them, we're teaching them, they're not contributing to the tax take yet, and then they're going, righto, I see a better future, see you later. 200-ish Kiwi people every day leaving.
Not surprising, and I can say this personally, there's the FIFO plan over in Australia. So you can go and earn 100,000 Aussie, you can be 18 years old, and you compare that to here where, youth unemployment's probably running at 25%.
Yeah.
Totally. How long do you stick around? How long do you wait? I keep saying to my son, the economy's going to get better, but how long do they wait? And when they know they can order a lot more. And you think about it as well, as I looked at this yesterday, the tax rate has come down in Aussie, but still 45%, the top rate. And there's other taxes on top of that. So, but you're still getting arguably you're getting a job for a start, and you're getting a relative better living, standard of living. So it's no surprise. The brain drain, we talk about that, it is occurring. So the net migration figures for the July 2025 year were 130, 13,000, should I say? 13,000.
Yeah.
That compares to a peak of 130,000. So we are a tenth of that. The amount of Kiwis leaving, obviously we're getting non-New Zealand citizens coming in, but they're not coming in as much as they were, and the amount of Kiwis leaving is a record as well. So have a look. I think we had 47,600 New Zealand citizens leave, which is a record. So it goes back to what we were saying before. New Zealand's not as attractive as it once was. There's less jobs. The cost of living is arguably higher. We've had inflation. We've had interest rates. Obviously they're coming down now, which is a good thing. So yeah, it's unfortunate that Kiwis are flighty, but it'd be nice to sort of not stop
them leaving.
Yeah, that's right. Yeah.
Well, it seems like we've had such a good run with those US stocks, and I remember when I first started investing, I couldn't access those. So I think that's why I'm so fascinated by New Zealand companies, because it was just too hard. But now, it's so much easier to invest into US companies, and a lot of us are via our KiwiSaver providers as well. And so we're keeping a closer eye on what's going on over there. It just seems like it's all going a little bit too good to be true in terms of markets, because they just keep going up.
The markets have done well in the US here, make no mistake about that. So the S&P 500, depending on when you're listening to this, it was up around about 13% year to date, and much more so from those lows when we had obviously Donald Trump bring his board out on Liberation Day with all those tariffs. But amazing year, like we talked about uncertainty, and we had a lot. Investors have had a lot thrown at them, with COVID. But then this year, we've had, as I say, the trade war. We've had tariffs, just rates going from like next to nothing to the highest they've been in the US in over 100 years. We've had backtracking, we've had threats, we've had countries all targeted, we've had industries targeted, but the markets have just all taken it in their stride. We've had the geopolitics that we talked about as well. And I think, it's sort of trying to boil this down and concisely is, it's difficult, but what we have seen, I suppose, and we'll talk about that maybe in a minute, is the technology sector really sort of leading the charge. We've got those big, I think it's 8 stocks with over $1 trillion. We've had the AI phenomenon, but stepping back from that, the US is the world's largest economy. It's been largely pretty resilient for everything that's sort of had thrown at it. The job numbers up until recently have been going along pretty nicely. Americans have sort of been getting by. Big difference, of course, American consumers versus us is that people have 30-year mortgages.
Of course, so they're fixed in, right, for a lot
longer. Fixed in, we talked about how we've been so battered, because we're all, jumping on 1 and 2 year rates, 30 years. So it sort of insulates things a little bit. But even that aside, diverse economy. Obviously, there's been all sorts of policies flying out of the White House, but the economy has largely been quite resilient. And this is without the Fed reducing interest rates at all until very recently. So
the assumption is, okay, the Fed dropped their interest rates, same thing as what we're seeing here. Money's going to go looking for a home, and then people are expecting, stocks are going to continue to rise. It almost sounds like it's too easy, and maybe something's coming at us that we can't see. I don't know. Like this morning, for instance, I had a Google and was like, right, Tesla share price, up 3.98%. And I'm like, oh, okay. But if that was Auckland Airport, when I was younger, I'd be like, holy, it's up 4% over in a day, what's going on? But there's almost like so much volatility that you're becoming immune to it, which is just such a fascinating time to live through.
Oh, yeah, and you're getting some huge moves. There's a company recently, Oracle, which is a big company. It's almost $1 trillion company, moved to the upside 30% in a day. Yeah. You saw plenty of this, when Trump did come out with his Liberation Day board, it was going the other way. So we were getting double-digit falls and some big names, and Tesla, you mentioned that's had its own problems associated with the involvement with the Trump administration, but very volatile, pretty sort of crazy stuff. But generally, the market, the US market has, I think, reacted to relative resilience in the US economy. The pro-growth nature of Trump's policies is still in the background, even despite all the chaos and turbulence it's sort of causing. And then it's only sort of really recently that and this is when the US markets have started to ease a little bit, is that there are a few signs of wear and tear on the US economy. And there's still the issue of tariffs, how that's going to impact inflation. Trump maintains that there are attacks on, foreign countries, they're not. They're paid at the border. The customs duties are paid, by basically whoever's receiving the goods. It's ultimately could be paid either by the company or by the consumer themselves. So we'll have to see how that all plays out. Even the Fed themselves, Jerome Powell says they're not sure. They think that it's going to be a temporary impact to inflation, but they're still not totally sure. But that's interesting with them. We talked about the RBNZ. Now the Fed are now more tilting away from inflation. They still have a dual mandate back towards the employment market.
Gotcha.
So we've had some jobs growth has weakened a lot, and you have the non-farm payrolls print every month. The last one was a lot weaker than expected. So there is a bit of a reaction by companies to what's going on and the uncertainty, and that has seen the Fed cut rates. So then and Trump's been obviously trying to get Jerome Powell to cut rates all year, but the economy, US economy has handled it well. You've also seen this in the earnings season. They have that every quarter. It's a very busy time in the US, and the message has generally been, things are sort of okay. They're turbulent and there's uncertainty, but people are still buying. And then at the background, you've obviously got the AI sort of craze, which is sort of keeping investor sentiment going as well.
Do you want to talk to those that may be newer to investing, explain a little bit about like active versus passive, but even starting with, okay, if my Tesla's going up 5% in a day and Oracle's going up 30%, what's that doing to the index, because the S&P 500 grouping together, say 500 companies, I was going to say countries, but companies, you've got some of these stocks at the top end of town are effectively then dragging up that entire index. Is that right?
Yeah, it is. Certainly their weightings have got to such that, so if you look at those top 8 companies which are worth over $1 trillion, they account for 35% of the S&P 500. If you want to take it a little bit wider, the US is a big market. Those companies account for 1/6 of the world's effective capitalisation from a market point of view. So they're huge impact, hugely relevant. So, they're deeply owned. And then, if we're going to sort of, I suppose, segue a little bit into that debate over sort of passive versus active, passive investor is effectively trying to follow an index, not trying to sort of take too many, if any, sort of moves outside of that. So, if they're in, the mega cap US stocks and they're in the index and they're going up, they're going to continue to sort of ride that wave, as it were. So I'd just characterise passive, and passive investors won't like this, but they're going with the flow.
Yeah, and so that might be they're investing for their child and they're picking a fund and they just dollar cost average into that every week. For instance, they'd be classed as a passive investor into that fund.
Yeah, that's right. And passive investor took off decades ago with the proliferation of ETFs. And it's just a way to follow effectively an index, but maybe with a few sort of minor tweaks. And I think, when things are really, really good, like the differentiation between passive and active is not as obvious. And there's the old saying about, rising tide lifting all boats. So the S&P 500 has done this. So if you've been on the S&P 500 tracker this year, you've just enjoyed that ride. When it does sort of come into its own, whereas when there's a little bit of divergence or a bit of volatility, I've seen short periods of that this year. And there's been various studies that have shown that, over a 30, 40-year period, active has tended to outperform in that environment. But then again, you get good active managers and bad active managers. So then there's a case of looking at that. The other thing, with the passive side as well, is there are obviously fees are also very relevant, and passive investors will say, hey, our fees are a lot lower. But, when you're following, say, I don't know, 1,000 stock index, and, you've got investors moving in and out, maybe you've got entry and exit charges, maybe you don't, there's fees that you're paying. So you're not just getting the index return, you're having to wear fees on top of that. I guess the idea of an active manager is, yes, you're paying a higher fee, but you're paying for that manager's resources to try and beat the index. And I think sort of that's what it boils down to. So I think it'll be interesting, if we do see volatility pick up next year, that I think you might see that potential outperformance of active relative to passive. But certainly in the current environment, you do see good active managers and bad ones. Unfortunately, generate. We've been, a lot of our funds are rated sort of top, if not in the top 3, across sort of 10-year time horizons. So I think when you're in that sort of category, you can justify getting paid a little bit more than a passive manager. But it's certainly interesting, one for debate. I suppose the other thing about it is, and this is getting a little bit more philosophical, is if you're a passive manager, you're effectively putting capital into companies, whether they're good or they're bad. And that's not conceptually what the idea of a market is around. You should be rewarding good companies and penalising bad companies. But
is that because they're part of the fund, therefore it has to be allocated to them?
That's right. That's right. So obviously if something happens and the stock price changes for other reasons, that will change. And then the other thing about it, I suppose, for those that are ESG aware, environmental, social, government, there's not really a part to play for passive there. So active investors can go and we do it, generate, engage with companies and say, actually, we'd like you to do this a little bit better. We've got X, Y, Z invested in you. Can you do that? The passive manager has zero role to play in that process. They're going with the flow. They're along for the ride. That's about it. So
most Kiwi don't have a financial plan. They have a she'll be right, mate attitude. Amy from Leverage is helping KTC listeners change that. If you're needing direction, clarity, or wondering what your next financial move should be, then book a call with Amy or download her free DIY financial plan to freedom. To do that, visit financialplan.co.nz. I'm sure you've probably seen this argument play out for your entire career, right? Because it always gets pretty noisy, really, the old active versus the passive and whatnot. I think where I got to with it, because I was actively managing my own KiwiSaver at one stage with no idea what fees were, and I certainly learnt what the fees were once I moved it all out. But, you've got to get comfortable with how you want to invest and then stick to your own values and whatnot. And then I think the danger for people is that they pick one way, but then they look over the fence and see something and are trying to, hop and jump between them all. Yeah. And that's where you start running into massive trouble.
Absolutely. And there's some really key words, most investors should know. And like one's diversification. You talk about sort of things you've learned over the years, and worst thing I ever saw were, people that just didn't diversify at all. They're like, I've got 30 stocks in my portfolio. But they're all mining stocks. Well, you're actually not diversified. Or you've just got one stock. It's a really good company. Yeah. And anything can happen to any company, no matter sort of how big they are. We've seen that play out time and time again. So, but I think you're right. The other word after diversification, the other D is discipline, and I think that's exactly what you're talking about. You're passive. No, I'm active. I'm going to do this. I'm going to do that. I'm going to try and time the market.
Yeah.
Actually, we had that yesterday. I talked to a bunch of people about KiwiSaver 101, and that really came up. Unfortunately, what we're seeing is a lot more people getting the idea of, the majority of people, in fact, getting the idea of it's about time in the market, not trying to time the market. Like, for example, the worst probably thing you could have done when Trump put up his tariff board was, after the market had that steep decline, was sell out or get out of the market, because you had this, those that did that and maybe sat in cash, now till now will be regretting it. Similarly in COVID as well, again, people weren't to know, but
I think it's different this time. People do know, because I was getting messages where I had people saying, I could see this coming, so I got out. And I'm like, so when are you getting back in? But I haven't heard from any of those people yet. So, but I reckon it's this is maybe unfair, but I reckon it's like a young lad, like a 20-year-old me. I was doing the same shit. I'm like, my KiwiSaver's only 10 grand. I'll tell you what I'm going to do with it. I'll time it. I'll take it out. I know what's happening. I've seen this before, and I timed it perfectly. But really, you then have to swallow your pride and go, I didn't see it bouncing back past this and doing it that quickly, but I didn't actually get back in. Or like I was actively managing mine and was putting it into gold in 2020, and I didn't stick with it. But it just did nothing for those 5 years. Now it's easy to be like, I should have left it in there with what we're seeing with gold at the moment. But I would have missed out on all the gains that I had through that period anyway.
Yes, exactly. Yeah. So it's trying to time it, and that's a shame, because obviously gold has done really, really well.
Yeah. Well, let's then look at KiwiSaver, since you mentioned that before. and some of the 101, it seems like the politicians are getting louder about, you know what, maybe we're not contributing enough. You know, National have done something about it. You've then had Winston come out and say maybe we could look at tax breaks, but let's get to 10%. And yeah, the whole maybe it becomes compulsory. Who knows? But you know, what have you seen out there, and what do you think it could make a big part of this next election?
I think yes, certainly will do as we get towards the election. So we've run a poll. We've had a poll going for a few weeks now, and Winston proposed, just to refresh, making superannuation compulsory, lifting it towards 8%. And then to 10%. So we ran a poll, we just went for 10%. Would you want to see it compulsory?
Yeah.
And 10%. So just under 80% said yes.
Wow. So that's surveying Generate members?
Yes, that's right.
Wow. Yeah, but they must be so well educated about it, thinking, we need to get this thing snowballing.
Yeah, it's just I think education is important because I think, and it became clear sort of talking yesterday at an event, a lot of people just don't, it's their retirement fund, but just aren't super aware in some cases about, the importance of it. And I think it will become increasingly important as we get to the election. I mean, we could spend a whole session on this, but I think the idea has a lot of merit, and it's easy to say as a KiwiSaver provider, talking the book or whatever. But if you think about it, there's a recent survey about the Financial Services Council. I think it was 44% of Kiwis, only 44% feel they're prepared for their retirement. So people feel underprepared. 30% of Kiwis between the ages of 18 and 65 are not contributing.
Yeah.
We've got 3.38 million, 5 million, I think it is, enrolled in KiwiSaver. We've got 1 million that aren't. So, if Kiwis are pretty poor savers, right? I think that's probably a bit of a generalisation, but historically we have been. So KiwiSaver was great. KiwiSaver has been going 18 years. So we're coming up to our 20-year anniversary. It's been great for the country. It's been great for our economic resilience. It's been great for creating nest eggs for people that might otherwise not have done that, might not have put that money away. It will reduce the government burden and thereby the taxpayer burden. But things have changed. People are living longer.
Yep.
It's got costlier to retire, to go retirement homes.
Insurance. Yep.
Everything's gone up. So do we need a little bit of a reset? I know we're going from 3% to 3.5%. To 4%, but is that enough? And we talked about international equities as well. So it is about education and awareness, and it was just not there. Around about, I think I was looking at this sort of in terms of the proportion that go into a default fund. I'll probably correct myself afterwards if I get this wrong, but I think it's around about 40% go into default funds. They're typically balanced. So I think the big thing about KiwiSaver, is it right for you? Is it right for where you are in your time of life, what you want to achieve and the like? So I think it has a lot of merit. Let's get the discussion going. Obviously there's questions about how to fund it on the other side in terms of the tax cuts that Winston Peters has proposed. But I think as things stand, clearly a lot of New Zealanders are feeling they aren't that prepared for retirement and probably don't have as much concept of how much they're going to need. At the end. And there's all sorts of studies you can sort of grab about how much you should be saving each year, and it goes progressive. When you're 30, there was a study from Fidelity, I think it was, saying you should be saving you should have 1 times your annual salary already saved.
To compound.
And then as you go up, that escalates.
Yeah.
So I think that's probably an important point. Massey University did a great study on what you need to live a reasonable lifestyle versus a no thrills one. It's pretty scary. A couple living in a metro area will need above their super $1.1 million. When they retire. That's now. That's today's money.
And a freehold home, right?
Yeah. That's in today's money. So think about what it's going to be like in
future
10 years, 15 years, 20 years time. So I think great to have the conversation. It is going to be a big election topic, and just and actually a bit of a commonality here, isn't there? Really, because Sweden is one of those countries that has compulsory superannuation. That's actually
I wonder if
pretty good for them.
The new governor is an ally to National, maybe, or that's completely independent, isn't it?
Well, yeah. Well, it is unless you're in the US, but actually it still is at the moment over there. But even closer to home, look at Australia. So they've got a head start. They've had compulsory super since 1992. They've got $4 trillion. So, they're some way ahead of us. So we're just around about 120 billion. We've been going less time. We're at 3%, going to 4%. They are currently at 12%.
Yeah. I was just pulling up these averages because I think that the New Zealand average balance is around 37,000, which is what you mentioned before, generates 42. I think that data was at the...
That's right, yeah. So I
can't remember what quarter
it is
the end
higher,
of,
so yeah, that's high. Yeah.
But people who get advice normally have a higher balance. Funny you mentioned earlier diversification, right? We are, I just feel like we're so far behind with our learning and understanding about investing because in New Zealand we don't really diversify. It's basically been... Like we understand we should do that, but basically it's like, pour all your money into a house. Like that's not really diversification.
No, not at all.
At all. But we think that we're well diversified. And you're like, how? But anyway, so then we've got to learn about that piece. But now you've got an aging demographic that are learning, I'm asset rich on paper, but this thing actually is a liability because my income's dropped, but I still have rates, insurance, repairs, etc. So they're getting some real rich dad, poor dad, or some accounting 301 lessons, which is a shame because we didn't teach them about diversifying and having different forms of funds. But even when I saw Winston talking about the 10% thing, the comments I was reading from people saying, I don't trust the government with my money. So there's still a misunderstanding of
absolutely.
Where does the money even go to? So I think we've got a long way to go. I think people listening to this podcast and the people we hang out with, we're into it, right? So you learn some of these things and someone corrects you and goes, mate, like Winston's not investing your money. Someone said to me the other day, like they take your money, my KiwiSaver's not real. And I said, well, how did the baby boomers or the 65ers, how did they take $3 billion out last year? Because they were saying to me, good luck trying to get it out. I'm like, well, then how did they get it? Do you think the money's fake? And they've got this belief about what it is. And it's concerning that how long KiwiSaver's been going, there's still this lack of education
absolutely.
For that subsection of people that are like, nah, I don't want to know about it, but what are you going to do is always my question. Like, what are you doing?
Education was a crucial part. And that point you didn't mention, we talked about housing a bit, but it's helped over 500,000 people get their first homes. So you can use KiwiSaver to get withdraw part of your KiwiSaver to help get on the property ladder. And we know sort of how hard that's been. So yeah, absolutely right. There was sort of a lack of awareness. Some people go, doesn't the government provide superannuation? Yeah, it does, but it's not going to be, it's not going to be enough for what you need. So awareness, education, big thing for sure.
I don't know if you're allowed to, but as a final question, mate, any prediction on who will win the election? And this can be a personal opinion. You can swerve the question, but I've been trying to ask people recently, and then we can go back and have a look and see what happens. It's September at the time of this. The election won't be for another 12 months, maybe.
Yeah,
Any prediction on?
I think National will. I mean, we will have had hope. I think. We will have had, and trying to sort of be agnostic. Is that the right word?
Yeah.
We will have had, those rate cuts that we talked about. Hope maybe people are feeling a little bit better about themselves. And I think, a broader question is, probably not the question you asked, but is 3 years long enough? It doesn't really feel it, right? You're sort of getting into your work in your first year, and then in your third year worrying about the election next year. It feels like a really short. The egg time is really, really short, and that's one thing I've sort of noticed, and particularly now that we're talking about, the election next year. Some things have been out, and whether you're Labour or National, some things have been out of control. We know who COVID. I mean, that's no one's fault, right? But obviously what we've seen this year with the trade situation with the US, some things arguably are controllable. I think, that we can be quite, and talking a little bit about before, again, maybe that's a bit of educational point as well about, what is the plan for whoever comes into government next? Is it believable? And will it make a difference to you or I or whoever's sort of voting? And I think that you just sort of have to weigh that up. But obviously, when elections come around, even both sides are trying to sell a
dream.
Sell the dream. And I suppose, often people do react to the now and the situation they're in, and do they feel worse or better than they did 3 years ago? So that will certainly...
Yeah, because it's one thing that sort of worries me for 2026 is that if we slowly start building a bit of momentum post the summer, people have some money in their pockets, and then the politicians are in our face and the media are slamming us every week with a scandal and what about this, and now they're promising this, and everyone gets back to that, the uncertainty kicks back in. We'll just wait until, after the election. So hopefully we don't see too much of that, and hopefully we have more people of the mindset of the CEO of Freightways, who's saying, you know what, we can only control what we can control. We've got to invest for the long term. And of course, the government that we have is a big factor in our lives, but we've got to get on with our overall strategy. And I think if we can implement that type of thinking as a household and leadership in our own households and businesses and communities and lives, like that's what we need, more of.
I'll certainly go along with that. So, look, the economy should be in a better place, leading up to the election. Whether that's enough for someone who's basically basing it on that as to whether to change from one to another. It remains to be seen. Not saying that it's going to be all sort of beer and skittles sort of this time next year, but we should be in a better place. I mean, we're not going to see stuff come down in price, are we?
No.
We're not going to see deflation, I don't think. But maybe we see the jobs market improve. We see the economy growing again, people getting a bit more confident. Time will sort of tell on that, and then obviously it depends what's happening internationally as well will be a factor. But we aren't actually in a recession at the moment technically, so I suppose that's a good thing. But that was a pretty sort of poor GDP read. But there's reasons to be a bit more optimistic. Is it too early to be talking about green shoots? I mean, some companies are starting to say that. During the earnings season we saw that.
Yeah, well, we shall wait and see, and we probably don't know what the next big fright is that's around the corner. I'm sure there will be one, and maybe we're a little bit desensitised to it with all that we've been through over the last 5 or so years, but good to catch up with you. If people want to get in touch or need to get in touch with you, how do they do that?
Email is good, so greg.smith@generate.kiwisaver.co.nz, or alternatively, greg.smith@generatewealth.co.nz. I won't give my mobile out just at the moment.
You might start getting unsolicited calls at 3 a.m. in the morning.
Although,
hey, mate, what do you think of this stock?
Although if you've got if you need an apprentice electrician, definitely fire that. But no, hey, pleasure being here, Luke. Really enjoy your work, and keep it up, and love to come on again sometime.
Yeah, I'm sure we'll definitely do that. Thank you.
Cheers.